Hello. Today, let us look at what we refer to as the bank reconciliation statement. Okay, and we are going first to start by understanding the two documents that are used in preparation of a bank reconciliation. And the first is the bank statement. A bank statement, it's basically a document which is prepared by the bank, okay? The bank that a business uses, showing all transactions and balances in a customer's bank account over a specific period of time, okay? Even as an individual, I'm pretty sure if you have a bank, your bank sends you a bank statement which shows the records of all the transactions that have happened during a certain period. Sometimes some banks do it monthly, others do it quarterly, okay? Just to show you the transactions that have been going through your bank. That is basically a bank statement, okay? Then the other thing is a cash book, okay? And a cash book is an accounting record of what a business thinks it has in the bank. That is the cash inflows and the cash outflows. The cash inflows are the debits and the cash outflows are the credits from the bank, okay? And this is managed by the business accountant, okay? So as a business, this is an internal document that you prepare yourselves, okay? Remember, we usually record all the transactions passing through a cash account. And when you want to reduce we want to show there is money into the business, we debit the cash account, okay? And when we want to show there is a decrease to a cash account, we credit, okay? So the cash inflows are the debits, the cash outflows are the credits, okay? So this is the day where the cash book is where we maintain the day-to-day transactions that are happening as we recognize them when they are happening, okay? So then we need at the end of a certain period of time, we can create something we call a bank reconciliation statement, which is because a cash book may have different balance with the bank statement, okay? So you said cash book maintains transactions happening in a bank, okay? And the bank statement on the other end, which is an external document from the bank, is having a different balance, okay? This happens and it is normal, and I will explain why, okay? So that is why we have to do a bank reconciliation. We see what is causing this difference balance between the cash book and the bank statement, okay? So let us look at first reasons that why a cash book and a bank statement may not be having the same balances, or some they may not have the same identical entries. What could cause these, okay? So one, it is unpresented checks, okay? So for example, if you write a check to, you're paying a certain payment to maybe your supplier, you write them a check. They are yet on your end. Once you do that, you need to record the transaction of paying this supplier of yours. So in your cash book, you're going to have a record of a credit item showing that you have paid this supplier, but this supplier is yet to present this check to the bank. So a check needs to be presented to the bank. The bank needs to clear, and then they make that transfer of that money. But on your end, in the cash book, you've already recognized that credit to your cash, but it has not yet been executed by the bank, because this supplier is yet to present it to the bank, or sometimes they have already presented it, but it has not yet been processed, okay? So that is one thing that mostly causes a difference between the cash book and the bank statement, okay? Then the other thing is uncredited deposit, sorry. So one thing I need you to know, in the cash book, before we continue, in the cash book, remember our inflows into the business, we debit them. These are inflows. If a customer pays us, we debit the cash book. And if we pay a client, that is outflows, we credit, okay? This is a cash account, is an asset account. So you understand an asset account, when we want to increase an asset account, what do? We debit. When you want to decrease an asset account, we credit, okay? That is why. But on the other end, in the bank, remember, a bank is another business by itself, okay? So sometimes you find these very funny, where you have deposited or money has been deposited into your bank and the bank writes this amount of money has been credited to your bank. You wonder, sometimes people feel like, okay, what do they mean, they are credit and I've just deposited money? Let me explain to you what happens. On their end, when you deposit money, it means they owe you this money. It is yours. Okay, it is, they are holding the money. So to them, it is a liability. We say it is a liability because this money is not theirs, but it is in the books. When they are doing their books, this money is a credit item because it is not their money. You get it? So in the bank statement, what is money inflow? What is money in? That is money in. If in your bank account, money has entered, has been deposited into your bank account, whether it's a business or individual, you're going to see this is usually recorded on the credit side. Why? Because on their end, this is not, they are recording it as a liability because this is not their money. This is money when you want to withdraw, you're supposed to withdraw because it is yours. So always note that. So money out will be a debit, okay? So note that difference, okay? So when we say uncredited deposits is maybe deposit has not yet been processed, okay? So we are yet to see that we are yet to see it in the bank statement that these depositors happened, okay? So note that. And then we have bank charges. You are not, when you're doing business, when you're preparing a cash book throughout the month, you're not going to know the bank charges that have happened during the month. When you're given that bank statement is when you're going to know this is the bank charges. Or sometimes someone could be picking every transaction, they take the transaction bank charges and they include there, but sometimes you could miss some bank charges, and most accountants actually wait to see what is the bank charges that are done for this month, and then they pass a journal entry for it. So basically, you see the bank balance is going to be different from the cash book if you are not included the bank charges. Then there is the direct deposits by customer, not yet recorded in the cash book, okay? So sometimes a client could pay directly to the bank. They have your bank account, right? And you are yet to know. They didn't inform you probably, so you didn't pass any journal, so we don't have this record in your cash book that this payment has been done. You see, now the bank will have more money than what you have recorded in the cash book, okay? So these are some occurrences that cause the difference between the cash book and the bank statement. That is why a bank reconciliation is very important, okay? Another thing is standing orders and direct debits. And standing orders, standing orders is basically where you tell a bank, please be deducting this amount of money monthly because you've taken this subscription, whether it is for internet, whether it is insurance, okay? Those things that you don't need to be doing every now and then, you just put a standing order on that bank. Sometimes you could miss, or you don't pass journals during the month for them. You just pass them at the end of the month. Maybe if you've not done so in your cash book, you're going to have no record of this, but it has happened in the bank. So you see that there's going to be a difference between your cash book and the bank statement, okay? Then another thing is dishonored check. It could happen both ways, okay? Where maybe you're given a check, it has bounced, or you have been given a check as a business, it has bounced. You see, in your cash book, when you are given that check, maybe someone is paying into the business and you are yet to present it. You already passed the journal to record that you have been paid, okay? But when it goes to the bank, it bounces, okay? Or on the other end, you wrote a check and you already passed a journal in your cash book. Then when the other maybe the supplier you paid goes to present it, or it's being processed in the bank, it bounces. Okay, so there are those two things. Then also you could have unpresented check is where you have been, I'm going back to this number one to give you a second scenario as well. You could be given you could pay a supplier, you've given them a check, okay, as mentioned, and then they are ready to present it for clearance. Or also a check could be it could be presented to you, but it is yet to be cleared by the bank. So you've already passed a journal to record that you have already gotten this check, but it is still being processed by the bank. So that is also going at the point when you're requesting for this bank statement. This amount is not yet has not yet been cleared by the bank. Okay, so these are the main causes of the difference between the cash book and the bank statement. And remember, at every particular point in time, we need to be able to record the correct assets. Remember, cash is what? Cash is a current asset. So we need to do a bank reconciliation to ensure we have the correct cash balance as at a particular point in time regarding of the occurrences of these things. Okay, so that is why we go now and do this bank reconciliation. So why do we prepare a bank reconciliation statement? Basically, a bank reconciliation statement is prepared to explain and reconcile the differences between the bank statement balance, okay, and the cash balance. That's basically why what is the purpose of a bank statement, and why do we do that? To first, to identify unrecorded transaction. As mentioned, you might have not recorded your bank charges. There may be a customer did a direct deposit that you were not aware. And then now when you look at the bank statement and the description, now you understand, okay, this was the payment from this and this, okay? Then a standing order that you missed, okay? So you make sure you identify any unrecorded transaction. Mostly you will find that these transactions are being shown in your bank, but you have not recorded them in your books, okay? Then the other thing is to dictate our errors, okay? Sometimes errors do occur. Mostly, sorry to say, it happens on the business side than it happens in the bank, because most of the operations of a bank are automated. Okay, so the moment you do, whether it is mobile or whatever, mostly it happens, it is automated. Okay, but some errors could also occur from the bank side, and the moment you notice it, you should write to them you should do a note to them to clear it, and then they're going to clear and write a letter, so as even them, when they're reconciling on their end, there is records to show why they have done that reconciliation. So there usually could be some errors. Maybe the amount was written the wrong way. Maybe you were paying 350, it is showing 315. Normal human error, okay? Such things, okay? So you will be able to dictate them when you are doing the bank reconciliation, because the documents that are being used to input these things are the same. Okay, whether it is the check, when you're passing a journal, you've seen that check and you're presenting it to the bank, right? So the amount is, if it is 350, it is 350. So if it is recorded in one place as 315, then it means one person did, either the business or the bank did the error. Okay, so a bank reconciliation is able to dictate these errors. The other thing is also to verify the accuracy of the records. You know, some people could be malicious. They could start making transactions in a bank. They could start stealing from a business, and when you pull the bank statement, you should be able to understand all the transactions happening in the bank, because you have recorded them in your cash book as well. If you find someone paid, the accountant paid them himself 20,000, and it is not recorded in the cash book, it cannot be explained. Where is it coming from? Okay, so also to verify the accuracy of records. Okay, So you can also detect fraud and unauthorized transaction. That is actually the point that I've spoken about. Someone making those unauthorized transactions, you will be able to know as well. Okay. Then also to update the cash book, which you will understand, we need, when we look at the bank statement, we will be able to pick any transaction that we might have not added. Okay. And especially the bank charges, mostly we pick them at the end of the period. When we take those bank statements, we're able to see these are the bank charges that have incurred during the period. Okay. Then let us use an example to understand these better. Okay. And when we are preparing a bank reconciliation statement, as I mentioned, we use two documents. Okay. Number one is the cash book. We pull a listing. Most in the current world, most things, we are mostly using the accounting softwares. So we just extract the listing from the report, their cash book listing from the system. Okay. So we are able to see this bank, this is the balances. Okay. Some businesses have more than one bank account. So they usually have a code. They have a code for each bank. So they will do a reconciliation for each bank separately. Okay. Always note that you cannot do a reconciliation for the bank for many banks in one. No, each bank should have its own bank reconciliations. So you are going to pull a listing for each specific bank because you have a code to identify that specific bank. Okay. So in our case here, we have this cash book. Okay, KM Traders has pulled this cash book for Karibu Bank. Most they indicate the bank account here. Okay, 00 whatever, so that you know this. When you look at it as an auditor as well, you're able to see this is a listing for this bank. So when you look at the bank statement, when you look at the bank statement, you are able to see the account number is the same. Okay. So this is a bank statement. This is a bank statement. I'm pretty sure some people are familiar with how a bank statement is. It's something you could pull if you have a bank. Okay. So this is the bank statement. You check and you come check here. So usually if you're looking now, for instance, you're going to look here at the cash book for the month ended 30th April 2026. Okay. So we are also going to pull the bank statement for the period of this month, 30th April 2026. Okay. So we want to do a reconciliation for this. Mostly we do, most companies do their reconciliation. They say, for example, we will be doing the bank reconciliation for this month by the 5th of the following month. Okay. So if now it's like 5th of May, that is when we are doing the bank reconciliation of April. Okay. And also the frequency of doing the bank reconciliation, it is usually stated in a financial policy of a business. Okay. So they are guided by their rules. If they see their transactions are many, then some even do the reconciliation weekly. Some even do the reconciliation daily. Okay. Depending on the number of transactions that they do in a day, they are due in a day. Okay. Some others do it weekly, others monthly, others quarterly. Okay. Depending on what the number of transactions they deal during a period. And this is usually stated. And if an auditor sees you're supposed to create but to do your bank reconciliation statement by the 5th of the following month, then means you're going to have 12, for example, 12 bank reconciliation in a year, and they should be done before 5th of the following month. Okay. So always when you put these rules in place, make sure you abide to them. So we have these two documents. We have the cash book, then we have the bank statement. Okay. You can see the structure. Bank statement, the structure depends on the bank that you are in. So let us the first thing that we will start by doing when we are preparing a bank reconciliation statement. Basically, one thing you should note, there is usually the header Okay, you have to show this is KM Traders Limited. Then this is the bank reconciliation statement as at 30th April 2026. So this is for the period 30th April 2026. Okay, so we are saying as at 30th April 2026 because we are going to know what is the balance, what is the cash balance as at 30th April 2026. So first thing is we are going to look at where is the difference coming from. So we start by balancing what is there. Like we check or to match, basically to match where do we look for the differences. Okay, so the first thing is we are to see the balance brought down is 80,000. This could be different. Okay, this could be different because remember when we are doing the bank reconciliation, when we are doing a bank reconciliation, we are not going to tell the bank if as long as there is no errors. If there is an error, we have to write the bank. But if this error, if what we are doing the reconciliation is from unpresented checks and anything that is basically a timing issue, because unpresented checks is the timing issue. It's just that it has not been processed. The bank has nothing to do it. When time comes, they are going to clear it, and that's all. Okay. So we are only doing the reconciliation to capture the correct cash balance on our end. So the balance brought down could be different for the bank statement, and it is okay because if we had an unpresented check, as we have already recorded it in the correct accounting period, then probably they're going to clear it on the first of the next month. So your balances may not be the same, but we are going to use another example to understand this. So in this case, for the two of them, the opening balance is 80,000, which is fine. Probably there wasn't any month-end differences during the previous month. So then we look at the next. We have cash sales of 25,000. We come and check the bank statement. Did we have anything like that? Yes, we have a deposit, that is a deposit of cash sales, and in here it's written the deposit because on the other side it's sales that we did, so money came in. So in the bank it's like a deposit. Also the description here matters from what the bank, whoever the person who made the deposit wrote. Okay, then we go back to our cash balance, our cash book. We have a check of 10,000. We have a check of 10,000. We come look for it. So we should see money in of 10,000, but we cannot see it. Okay, so what do? We make sure we note this one. So here let's use this. Let's use that. Actually, we could use opposite because now don't want to confuse anyone. So we have seen 25,000. So what we've not seen is 10,000. We'll come and now ask ourselves questions of why we have this in our cash book and it is not in our bank. Okay, so we have EFT receipt. We have EFT receipt of 15,000. So we come check it. Do we have any EFT? Yes, we have. So we tick it. So here we said we use a tick. Okay, we use a tick. So here we have it. Yeah, we don't need to, but okay. So we come back here and then we say, okay, this is fine. Then rent payment of 8,000. We come check. Is there anything like that? Yes. Remember what I said about this money here. Most the banks these days, they change this to money in and money out because I think they realize many people are confusing and wondering why there is a credit when I've deposited the money. Okay, but money in to the bank is in the column under credit as mentioned, and then money out is a debit. Okay, to them. This is how they record to them because this is how they understand it. Because when it is money in, it means they owe you. Okay? And if it is money out, it means they don't owe you 3,000 because this, for example, yeah, 3,000 because it has gotten out. Okay? So that is the difference. So sometimes in the bank statement, you're not going to see money in, money out. You're going to see credit, debit. So you will know a credit is money in, debit is money out from the bank. Okay, so we have 8,000 there, 8,000 there. Then so we tick here, and then check received, we have 6,000. We come check it here, we don't have any 6,000. So what are the differences? What are the differences so far? One thing, we have not able, from the cash book side, we cannot trace 10,000 and we cannot trace 6,000, right? Then on the bank statement, we also have to check what are the things that we have not traced on the cash book. We cannot trace this 3,000. This is a standing order insurance cost. We cannot trace 1,000, which is a bank charge, and we cannot trace direct debit internet cost. Okay, we also cannot trace a customer direct deposit. So we start by asking ourselves, what is happening? First, when we look at our cash, our bank statement, we can see there is a standing order insurance of 3,000. We ask ourselves, do you usually incur any insurance cost? Yes, we have an insurance cost that we have a standing order with the bank to pay insurance 3,000. So what did we record it? No, we didn't record it in our cash book. That is why it is missing. So we have to pass a journal. To do this. So in this case, we are paid for a certain insurance cost. So what do we do? We debit insurance expense. Okay, as definitely we have supporting documentation of why we are paying for this insurance. Could be a certain policy we have with them. Okay, so we need to ensure we have support to show why is this transaction happening. Okay, it's just that we already have a standing order for it. Okay, so we credit the bank, we credit cash account, cash in bank account, an amount of 3,000. Okay, so we basically will, in our updated cash book, we are going to have included the cash, this credit of cash in bank of 3,000. Okay, then we go back, we check. So we have done this. Okay, then we come to bank charges. We see, okay, yeah, there's no way we could have known what are the bank charges. But now that we know the bank charges during the period, remember, bank charges are an expense. Okay, it is an operation cost for using that bank. So they deduct it from your money directly. So what do? You could have an account called bank charge expense. Remember, an expense account, you debit to increase it. So here we are just debiting. Okay, debiting an amount of, what is the amount? 1,000. Sorry, this is the bank statement, is 1,000. And then we credit bank, we credit cash in bank, account, an amount of 1,000. Okay, then we go back. What is the other thing that is causing a difference? Direct debit internet cost. This is because we have this subscription, and there is a standing order to pay for our internet in the office, and it is a direct cost. They just deduct it from our bank. So we might have missed to record this in our cash book during the end period. Okay, so we also make sure we do that. We debit maybe utilities cost, or just operation, just any operation expense account. Okay, that you have agreed to record this. So this is 2,500. So 2,500, and then you credit again cash. You credit cash in bank account 2,500. Okay, then you go back. what else do we have in our bank is we have customer direct deposit of 5,000. Okay, so we investigate. What is this? Sorry, I recorded it in the wrong place, but this is basically this. Sorry, this is for direct debit internet cost. Okay, sorry. Let me just correct this. So here we have direct debit for internet costs, and then here we have customer direct deposit from the customer. Okay, so we ask ourselves, oh, okay, where is this money coming from? So the bank usually has a very clear description. So, and we also, if you ask our client, oh, you said you paid, please send us proof of payment, and they send you. So you realize, okay, so they made a payment to you. Maybe it's the client who sold on credit, and they didn't tell you. Okay, so you can see it is even at the month end. So you didn't know this transaction happened, so you didn't record it in your cash book. So what do? You come this time round, it is money into the business. Remember, even when you look at a bank statement, the money is money is coming into your bank. Okay, so what do? You debit the cash in bank, because now they are depositing into the bank. Remember, the other cost you were paying for, the bank was taking money out because you're paying for internet, you're paying for insurance, you're paid for what is the other thing? You are paying for bank charges. Okay, so this is cash in bank. We have 5,000. Okay, we have 5,000. Then we are going to credit. For example, if we had recorded this in our account receivable, we need to credit the account receivable account, which is 5,000. We are going to credit an amount of 5,000. So we basically don't make adjustment to the cash book anyhowly. We pass journals to make sure that this adjustment has happened to our cash book. So because these days we are doing this, we are using the accounting software, so we have to do those the journals. Even if we were doing it manually, we have to indicate the journals and record this appropriately. Okay, so we have explained where these differences are coming from. Okay, so we have mini ticked them because we will update our cash book balance from what we had missed, that is in the bank statement. Okay, but you can still see our balance is 110,500, and our cash book is 108,000. But remember, we have understood all the differences that are being caused by what is in the bank statement, and we have not finished checking what is the why don't we have 10,000 in our bank statement. This is the cash book now, and why don't we have 6,000 in our bank statement? Okay, so we have check number 101. We can't see it in our bank statement, and it's on our credit side. So we gave someone this check. What has happened? It is just that they have not yet presented this check. That is, they have not presented this check to the bank, so the money has not been deducted from our bank. So what does that mean? This transaction, you're not going to see it in your bank statement. Okay, then we have this 6,000. We received this check on 24th of April 2026. Maybe we asked for this bank statement as at that year, the day 30th. Okay, that is when we pulled the statement, and they had not yet processed this check. So we sometimes give the bank the check, but it could sit waiting for processing. Definitely our bank is also busy, so it could take some time to process this check. Okay, so this check, basically, it is not, that is why you cannot see this balance in your bank statement. So we have to do something about it. Okay, so this is where now the bank reconciliation comes in. Okay, we ask ourselves, first, what is the balance as per the bank statement? The balance as per the bank statement is 110,500, okay? 110,500. That is after identifying that there is no issue with there is no error with the bank. Okay, there isn't any error. We need to write to the bank and tell them, okay, yeah, there is a problem. The check we presented was 10,000, but we are seeing here you did 100,000. Okay, so as long as there is no error on the bank, which is, I said, it's a rare case because banks processes are mostly automated. Okay, so once we know that, we add check received but not yet banked or not yet cleared. Okay, so which is 6,000. If you can check from our cash book, we investigate where is this coming from. Okay, usually when we pass our journals, we usually have a proper description of what happened. Okay, so here we have this check. You know, mostly for bank they have a relationship manager, so they are able to inquire, hey, we gave you a check, what happened? And they're like, okay, we are busy, it's just that we have not yet clear, we will clear it tomorrow. So we know, okay, there is no problem, they're going to make to clear it. Okay, so here we come and indicate we have this 6,000. Okay, it's just that the bank has not yet executed the process of clearing this check. Okay, that we were given this check is we were given by a customer as a payment. Okay, then we also less unpresented check. Why are we lessing unpresented check? It is because unpresented check is a payment out. It is a payment out. So it is a credit to us because this person, when they go and present this check to the bank is going to remove money from our bank. Okay, so we are going to have a less of 10,000, a less of 10,000. Okay, so if we do summation of this 110,500, we add 6,000, we less 10,000, you're going to have a balance of 106,500. Okay, now let us look at how our cash book, once we update our cash book, how will it look like? Our cash book balance. What was our cash book balance? Our cash book balance was 108,000. 108,000. Okay, then we are going to add customer direct deposit. Why? You will remember we passed the journals. Okay, so this will be updated in the cash book. Okay, so our direct customer deposit, remember we were debiting cash, so it is an increase to the bank because we are receiving money. We received money, it's just that we had not recorded that we have received this money, so we need to add a 5,000. Okay, then we less standing order insurance because this is money out from our account. Okay, you can see it is a credit. This is a credit of 3,000, so it's less 3,000. Then we are going to less bank charges. Bank charges also is a credit to the cash account, so we less 1,000. Then direct debit internet as well is a credit. Is a credit because it's a payment of internet costs from our bank, which you're going to less 2,500. Okay, so we are going to have 108,000 plus 5. We add 5,000 less 3,000 less 1,000 less 2,500. You are going to have 106,500. Now you can see after adjusting for our bank with what they have not yet done on their end, the balance is 106,500. And also when we adjust our cash balance, it is 106,500. Don't forget, you're not going to call the bank and tell them, okay, please do the check, clear the check, whatever, because by 30th of April 2026, they had not yet done that. But we were looking at the financials on our end. As at 30th April 2026, we need to have a true representation of the cash balance, which is 106,500. 500. Okay. The bank will continue with their business normally, but us is to ensure that we have presented our cash balance as at 30th April 2026 correctly. Okay. So the bank will, what they will do is they are going, once this person present the check, they were going to deduct this 10,000. And then once they clear also this one, 6,000. So in the next bank reconciliation, you will be able to clear them. So if you look at the bank statement that we've prepared for April, when we check the bank statement for May, we are going to find these items are one of the things that are causing the opening balance to be different. So as an auditor, you will look at it and you will be able to clear these items in the following bank reconciliation, because it is going to list the differences that are causing the bank statement balance and the cash book balance. So throughout the period, you will have a record of what is causing the balances and what you're pushing this to, especially these items for check received or unpresented check. You're going to clear them because you're going to see them in the next bank reconciliation, trying to explain the differences in the balance in the bank statement and in the cash book. Okay, so this is a very key statement that is prepared by a business. Mostly they do it monthly to ensure that they have a fair representation of the cash balance as at a particular end of an accounting period. Okay, remember we are required to present the correct fair balance as at a particular point, because then we will have presented the correct assets, because remember cash is the current asset. Okay, and that is it for today, but we are going to do more examples of this so that we're able to understand all occurrences that occur to cause this difference, and see what do we do to now come up with the correct cash balance as at a particular point in time. Okay.